So we've done exactly what we expected in the last couple of videos on ICP. The bull managed to push his head up above this trend. We expected that because this was a descending channel. A descending channel in a bearish move is actually bullish. Once you've cracked your head up, that's where momentum starts changing. So is it a good time to enter ICP? What we're going to do is we're going to be using hypothetical scenarios and we're going to be using characters to make it easier from a psychological perspective how you can increase your risk to reward on any single trade. Okay, I'm really going to do things a little bit differently in this video, ICP Army, so let me know if anything sticks on here, because what we're actually focusing on in this video is how you can get a lower risk and a better reward, maximizing your reward and minimizing your risk. That is going to give you the hugest edge in the market, and we're going to be using characters, guys. If any of you are like me, reading a book, guys, I don't take things in as much reading a book, but visually I can understand things. So we're going to be using the bear, that's our barrier, and we're going to be using the bull, that's the entry. So you know where the stops go, guys. The stops always go below the previous swing low. We're going to be talking about that very shortly. So what does the bear do? The bear's the barrier. The bear's the guy that's telling us that this is time to sell. This is time that there's going to be a resistance. This is time where the price is unlikely to get a break and a close without any kind of reaction. Why is that? Because it's the previous higher high. So you're shooting for the previous higher high and you're in a downtrend. Now this trend is an important trend because how can we confirm it? You've got one touch here, you've got two touches, you've got three touches, you've got 4, 5 touches. Once this trend is broken, that is going to give us a signal that the bulls have regained momentum, and that's going to give us a signal that we need to look to start entering. It's not financial advice, guys. This is hypothetical trading. So we talked about this descending channel. We said once we broke our head from the descending channel, that was going to turn bullish. That was a bearish move in the first place. When you're bearish, pulling back in a descending channel, it signals exhaustion. So we expected the big push to the upside, and we got a big volatile candle a couple of days ago. That candle doesn't look much, but it's actually 8.69%. So it's nearly 10% up so far from a couple of days ago. So is it a good time to enter? It's a question in everyone's mind. Is it a good time to enter now? We're still in this trend, guys. We haven't cracked trend. We haven't broken trend. So what's to say that we're not going to get rejected here again? Been rejected, 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 rejected. What's to say we're not going to get rejected again? And how can we tell if we will get rejected? Bring up our stochastic. So if the stochastic is pulling up and we're at a rejection point here, then you're likely to get a pullback on the stochastic. Now, is that a bad thing if you get a pullback and a rejection on this? Because what it can actually do is bring the indicators back down, you hold support, then you've got a better turn for a crack of trend. So if you get a crack of trend here, is what I'm saying, and you go straight through, what does this do to your risk to reward? People think it's the end of the world when they can't take a trade. What does that do to your risk to reward? So if you get a crack above here, that brings your risk to reward to 1.97. Now, remember what we say about the bullseye strategy. Remember what we say about risk to reward. I like to have a minimum of 2 to 1 risk to reward. So I wouldn't be able to take that. So does that mean that that trade's done? No, it doesn't. We can look to see how price action behaves. That's two scenarios. That was if you broke here. That was if you come back and you pull back and then you retested another break, then you've got another scenario, guys. Now, these scenarios, you tend to get flash wicks. When you get a break of previous resistance and then you get a test of support, what often happens is you'll get a flash wick to the downside. So that flash wick to the downside will be buy orders, buy orders, buy orders, buy orders, eating up the price. So a retest, is what I'm saying, can actually be quite difficult. So you get the break and then you come back, get a retest. Retest can be like this, volatile spike straight down and up. So what I'm saying is if you're looking for a retest, that's where limit orders come in, guys. If you're looking for a retest, you can't always see exactly what's on the chart at any given time. So you'd put a limit order at your previous support. So what would that do to your risk to reward? If you've got a break here, rejected at this 61.8, and you've come back down and you've tested this previous resistance as support, you've got your 786, fall back on, that's holding support. Bring your risk to reward tool down, shooting below the low. That brings it to 5.74. So there's lots of different scenarios that play out, guys, but it doesn't mean that you should take the first one. If you've got a strategy and you've got a rule set, that's fine. If you haven't got retests built into your rule set, build them in, guys. See what happens. See if you can increase your risk to reward. Go back and back test it. Go test it against what you've already done. Because it's all about how extreme the how volatile the break is to how good your risk to reward is going to be. Because what often happens is If we got a crypto narrative, if Donald Trump or if anybody said something positive about crypto in the next couple of days, crypto is going to rocket. We're going to get a break of all-time high of total 3, and that's going to confirm for me alt season. What I'm saying, how does that reflect ICP? If we got that, you could get some kind of a break like that where it's so volatile. But what would that do to your risk to reward? Unless you got the pullback, that's 0.74. So this is your risk at all times. This red box is your risk at all times. This green box is your reward at all times. So the aim of the game, it doesn't have to just be ICP, guys. It could be any crypto. There's tens of thousands out there. However, don't go on the DGen ones that haven't got much data because the technical analysis doesn't stick and there's no sticking points from previous data. So unfortunately, they don't work as well. So the aim of the game, guys, is to bring our risk down as much as possible, as much as possible, as much as possible, and bring our reward up as much as possible. So exactly the same thing's going to be playing out, guys, but it's all about where you enter the market, how you enter the market. Is your risk to reward good enough? And have you protected yourself? So what happens? Let me just give you a hypothetical example. So what happens? Pretend that's the 618, guys. So pretend that's the 786 and pretend that is the 618. What actually happens quite often is you will get something that pulls back. So there's your 786, there's your 618. You've got price action that's rejected at the 618 and it comes down to the 786. You'll see it holding the 786 and holding the 786 and holding the 786. We can then look for clues on the indicators to see if we're oversold. If we're oversold at this level, what does that do to your risk to reward? Bring up our risk to reward tool. You're holding support, guys, because you're holding support for such a long period of time. And that means if you were shooting, just as an example, back for the 618. So that's a 3.78 to 1 move. So it's 3.78 risk to reward move. And that was just an example from a 618 to a 786. And I know that's hypothetical, guys, but what it does is it allows for tight stop losses. Once you've got a strong base that's held for such a long period of time, you know exactly where you need to be wrong. So you've got a tight risk, you've got better reward. And if you're wrong, guys, ultimately, if you think that the trading's is easy, that you're going to get an 80%, 90%, 100% win rate, guys, you're dreaming. Crypto is a probabilities game, and people will be wrong. I'm wrong. Lots of people are wrong. Anyone that thinks that they're a guru is complete bull, guys. There is no gurus. Ultimately, price does whatever the hell it wants, and it could do this. And if it does this, what do you want to be out? You want to be out with a limited amount of risk, because if your risk was down here and then you got a pullback and a continuation to the downside, then obviously you're risking a lot more capital. Less amount of capital at risk, most amount of capital at reward, guys. The best traders in the world have only got about a 30% hit rate. So that means they lose about 70% of their trades. So think about that. Okay, if you found this useful, guys, if you want me to start using bulls and bears as analogies, let me know in the comments if this did actually help you, because this is how I learn, guys, by pictures. So tell me if it helped you, and I'll see you in the next one.